Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for chapter 11 in our textbook, where we're going over depreciation and depletion mainly. And then in chapter 12, we get into intangible assets and amortization a bit more. So I'm going to share my screen with you, and then we'll go over these PowerPoints together. Of course, get some practice with these calculations in class together. So hopefully you are seeing the Chapter 11 PowerPoint. And again, in Chapter 11, we're looking at calculating depreciation, asset impairments, and depletion. So some of our learning objectives, understanding depreciation concepts and the different methods of depreciation, explaining special depreciation methods and other depreciation issues, explaining the accounting issues related to asset impairment, explaining the accounting procedures for depletion of natural resources, and explaining how to report and analyze property, plant, and equipment and natural resources. So as we've talked about before, and we've gotten practice with not only in principles of accounting, but a little bit in intermediate accounting so far, you know, basically depreciation is a systematic way of allocating the cost of an asset over its useful life, right? And so, you know, thinking about, for example, the straight line method, we take cost minus salvage value divided by useful life in years, right? So we're allocating, or we're dividing up the cost of the asset over its useful life. And so when we think about these long-lived assets, you know, fixed assets, we depreciate. Intangibles, which again, we get more into intangibles in chapter 12, but intangibles we amortize. Natural resources we deplete. So depreciation, amortization, depletion are really three of the same types of calculations, or really the accounting principle behind those calculations is similar. You know, if we're depreciating, if we're amortizing, if we're depleting, we're dividing up the cost of the asset over its useful life. We just call it something different depending on the type of asset class. So again, property, plant, and equipment depreciate, intangible assets amortize, natural resources deplete, right? All right, so a couple things that we have to ask ourselves when we're doing these calculations is, what is our depreciable base? First of all, the depreciable base is always the original cost of the asset minus salvage value or less salvage value. So like in this example, it's showing us the depreciation base of 9,000, right? We do not depreciate the salvage value. So what's the asset's useful life? Depending on which method we're using, we're either going to be talking about useful life in periods, usually years, or useful lives in units of production. And then what method of cost apportionment is best for this asset? So the straight line method, the activity method, the sum of years, digits, declining balance. Again, those are the four depreciation methods that you guys have to be able to do for your final exam. And so we'll definitely get lots of practice with those together in class. All right, so the straight line method, again, this is one that we have seen hopefully before. We remember this from principles of accounting. The formula for this is the cost minus salvage value divided by useful life in years. So in this example, we have a crane that cost 500,000. Estimated useful life is 5 years. Estimated salvage value is 50,000, and then productive life in hours, 3,000 hours. So For the straight line method, we're going to use the 5 years, but as we'll see, like with the units of production or the activity method, we would use like the 30,000 hours as the denominator, as the bottom number. But if we plug our numbers in here, we end up with basically 450,000 divided by 5. So we're going to depreciate 90,000 per year on this asset. The activity method, again, the activity method is also called the units of production method. And so thinking about this, example for the crane, we're still going to take cost minus salvage value, but instead of dividing it by useful life in years, we divide it by total expected activity, or in this case, total productive life in hours, right? 30,000 hours. And then we multiply it by however many hours were used that year. So, this is showing it to us in just one step, and that's fine. We'll do it both ways in class together. But the other way to do it is if we break it down into a depreciation per unit and then multiply it by the number of units. So, if we took out hours this year, if we took that out of the numerator, that would give us depreciation per unit. And then we would just multiply that depreciation per unit times 4,000 to get the depreciation charge for that year. So there's a couple different ways to do this one. They're showing you just the one step formula, which is perfect. Other accounting textbooks show it to you in 2 formulas. So, we'll get practice both ways. The sum of the years digit method. So as we'll see with sum of years digits and with double declining balance, they are considered accelerated or decreasing charge depreciation methods. Because their depreciation expense is greater in the early life of the asset and then reduces as the asset gets older. And so on this example, again, we're using the example of the crane. To get the sum of years digit fraction, we're just adding, just like it shows here, this is a 5-year asset. So 5 plus 4 plus 3 plus 2 plus 1. So 15 is our denominator on our fraction. And then whatever year it is, so if we're on year 1, we still have 5 years remaining. So we're using the fraction 5 over 15 to calculate the expense. If it's year 2, then we only have 4 years remaining. And so we're using 4 of 15 to calculate depreciation expense. At year 3, we've only got 3 years remaining. So we're using 3 of 15. And again, we're taking the 450,000 times 3 over 15 to get that depreciation expense, right? So, it's not bad. If this is a 5-year asset, then it's real easy, 5 plus 4 plus 3 plus 2 plus 1. But when it gets to be like a 20-year asset or a 30-year asset, this becomes a little bit more difficult. But your book does show us like a little shortcut that we can use to calculate this as well. So again, we'll get practice with it both ways in class together. The declining balance method, and usually, another name for this is double declining balance method, because we usually double the straight line rate. So, again, just like, and it shows it down here, this is a 5-year asset, right? So if we were thinking about depreciating this asset over 5 years, we would depreciate 20% per year, right? Because we just take 100%, divide it by 5, 20% per year, right? If it was a 4-year asset, 100% divided by 4, 25% a year, right? So with the declining balance method, we have to calculate that straight line rate first, and then we double it. Okay. So then we're going to depreciate 40% per year, double the straight line rate. So first year, book value is 500,000 times 40%. First year, we're going to depreciate 200,000. Since it's the first year, we've only accumulated 200,000 and we're down to ending book value of 300,000. Where we end year one is where we begin year two, right? So year two, beginning book value 300,000, we're depreciating 40%. So we're going to depreciate 120,000 the second year. Now we've accumulated 2 years worth. If we add, 200,000 plus 120,000, we've accumulated 320,000 of depreciation, and book value's down to 180, right? Remember, book value is always the original cost of the asset minus accumulated depreciation. So on and so forth until the last year. Again, we don't want to depreciate below that salvage value. We want to leave that book value, that salvage value of 50,000. So whatever adjustment we need to make year 5 to the depreciation account, we want to depreciate a total of 450,000. Okay, so two special depreciation methods, the group method and the composite method, depending on the type of assets. Both of these methods are basically the same. What we have to do is find an average or a weighted average, if you will, to determine how we're going to depreciate these assets as a group, essentially. So on this one, if we had straight line depreciation, total would be 56,000. And our original cost of our assets, 224,000. So we're depreciating about 25% per year, right? And then for the composite life of the asset, because again, we've got one asset that's 3, one asset that's 4, one asset that's 5. So if we take our 190,000 depreciation cost divided by the annual depreciation, that gives us a composite life of about 3.39 years. Again, this is something we'll get practice with in class together. The calculations aren't too bad, I think. Just plug in the correct numbers into the formula, right? Okay, so impairment. So assets can be impaired, which basically means that they have lost value for some reason. We saw this when we talked about our inventory accounts and how the inventory accounts can be impaired. And then sometimes we've got to use, lower of cost or net realizable value or lower of cost of market. And so just like it's showing here, some of the events that may lead to an impairment, a significant decrease in the fair value of the asset, a significant change in how the asset is used, a significant adverse change in legal factors or in the business climate that affects the value of an asset, an accumulation of cost in excess of the amount originally expected to acquire or construct an asset, a projection or forecast that demonstrates continuing losses associated with an asset. And some of the ways that we can measure impairment. So we want to review the assets for possible impairment. If the review indicates impairment, then we need to apply the recoverability test. And if there is an impairment, it says the impairment loss is the amount by which the carrying amount of the asset exceeds the fair value of the asset. And I believe it shows us an example of this on the next slide. So here's an example of that out of your book. This is illustration, I guess, 11-16, I think, out of your book. But recoverability test, expected future net cash flows less than carrying amount. If no, then there is no impairment. If yes, then there is impairment, right? And so is it an asset that's held for use or is it an asset that's held for disposal? If it's an asset held for use, we have to record the impairment loss, the excess of carrying amount over fair value, depreciate the asset on the new cost basis. If it's an asset held for disposal, then just like it shows here, we have to record the impairment loss, but there is restoration of the impairment loss permitted if we do sell the asset for above the carrying amount. All right, so here's an example of that, and I'm just gonna click here till I, oh, hot dog. Okay, so it says M. Alu Inc. has equipment that, due to changes in its use, it reviews for possible impairment. The equipment's carrying amount is 600,000. That's the 800,000 original cost less 200,000 accumulated depreciation. Alu determines the expected future net cash flows undiscounted from the use of the equipment and its eventual disposal to be 580,000. Determine whether an impairment has incurred. So, I mean, you know, just by looking at the numbers here, if we have a carrying amount or a book value of 600,000 and we expect future cash flows of 580,000, then we have a $20,000 impairment, right? That's what it's showing us here. And so that, geez, I always click one too many times. And so that journal entry is a debit to loss on impairment. Remember, losses get debited just like expenses would, right? So loss on impairment, debit, and then credit accumulated depreciation. And on this example now, it's showing us on the previous slide, it said, okay, if the fair value of the equipment is, what did it say back here? 580,000, we would have had a $20,000 impairment. But on this one, it's saying, okay, assume this asset has a fair value of 525. Again, if we have a book value of 6 and it has a fair value of 525, then that's a $75,000 difference, right? Okay, natural resources. So again, we can also divide up the cost of natural resources over their useful life. But instead of calling it depreciation, we call it depletion. And again, we call it depletion because, you know, as we're pulling these natural resources out of the earth, for example, we are depleting that natural resource asset. So, you know, as we're pulling coal out of a coal mine, that's depleting the coal mine, right? Or as we're pulling gold out of a gold mine, right? We're depleting that gold mine. So we call it depletion, but it really is the same thing as depreciation, just it's a different type or different asset class. So we call it depletion. And for depletion, as we're going to see, we always use the units of production method or the activity method. So just like it shows here, natural resources often called wasting assets, because again, as we're depleting those assets, we're depleting that natural resources or natural resource. They have two main features. So the complete removal or consumption of the asset, and then the replacement of the asset only by an act of nature, right? It's a natural resource. So a couple things that we need to consider when computing depletion. So obviously the acquisition cost of the asset. If we have any exploration cost on top of that we're going to capitalize, any development cost, or any restoration costs. So a few things we have to consider. So just like it shows here, and again, I mentioned this when we looked at the units of activity method or the units of production method, total cost minus salvage value divided by total estimated units available. That gives us depletion cost per unit. And then however many units we extract, we're going to multiply that by the depletion cost per unit to get our depletion expense, right? So here's our example of that. It says, McLeod Company acquired the right to use 1,000 acres of land in Alaska to mine for silver. The lease cost is $50,000 and the related exploration cost on the property are $100,000. Intangible development cost incurred in opening the mine are 850,000. So for the cost basis or the acquisition cost of this asset, we're going to use 50 plus 100 plus 850, right? Just like we're showing down here, the cost of 1 million, right, as our numerator. McLeod estimates that the mine will produce approximately 100,000 ounces of silver. So we are going to deplete $10 per ounce, right? So as we're extracting the silver, for every ounce of silver, we're going to deplete $10 per ounce. So just like it shows here, if McLeod extracts 25,000 ounces in the first year, then the depletion expense for the year is 250,000. And just like it shows here, then we'd have that silver available for sale, presumably. So we'd be debiting inventory, crediting the silver mine asset. It says some companies use an accumulated depletion account. In that case, McLeod's balance sheet would presented as follows. Would be presented as follows. I guess there's a word missing there, but so the silver mine, if we got it at 1 million less accumulated depletion, we'd have that book value again, 750,000. Okay, so estimating recoverable reserves, just like it shows here, this is not a retrospective adjustment. We don't have to go back and make any adjustment for previous years. When we have a change in estimate, that's a prospective adjustment. So we just make adjustments to our calculations for upcoming or subsequent years, right? So it says revise the depletion rate on a prospective basis. Again, we don't have to go back in time. It's not retrospective adjustment. We just have to fix our numbers or calculate our numbers based on the revised rates, the revised depletion rate, and divide the remaining cost by the new estimate of the recoverable reserves. All right, liquidating dividends. So dividends greater than the amount of accumulated net income. Here's our example of that. It says Callahan Mining had a retained earnings balance of 1,650,000, accumulated depletion on mineral properties of 2,100,000, and paid in capital excess of par of 5,435,493. Callahan's board declared a dividend of $3 a share on the 1 million shares outstanding. It records the $3 million cash dividend as follows. So it's kind of strange. I know this relates to depletion. We're talking about depletion, but we really get more into how we handle these stock transactions and dividend transactions in chapter 14. But on this example, remember, retained earnings generally increases with a credit. And that's the same for paid in capital excess of par. Generally increases with the credit. So we are decreasing. We're issuing this dividend. So we're decreasing retained earnings. We're decreasing paid in capital. We're crediting cash, right? All right. And then a few ways that we're able to analyze these types of accounts and these types of assets that they're going to show us. For example, calculating a return on assets, how these would be presented. I mean, I think at this point, probably most of us know, right, that property, plant, equipment are assets, natural resources are assets. They're going to be in the balance sheet under assets. And property, plant, equipment, or fixed assets, we list the book value of the asset. So that's the original cost minus accumulated depreciation. If it's a natural resource asset, usually we would have the cost of the natural resource asset less accumulated depletion. But But, you know, when we think about the financial statements, so our annual expense, our annual depreciation expense, or our annual depletion expense, that's going to or amortization expense, really, too. We could include that. We talk about that more in chapter 12, but those would show up on the income statement, right, for that year. The accumulated accounts are what show up on the balance sheet. And so, you know, again, property, plant, and equipment, less accumulated depreciation. Natural resources, less accumulated depletion. Intangible assets, less amortization, right? All right, so the asset turnover ratio, again, like we see here, oh, hot dog. Like we see here, that formula, net sales divided by average total assets. To get that average, again, we have to take beginning of the year assets. We have to take end of the year assets, add them together and divide by 2 to get the average. So in this case, we have asset turnover of 0.56 on this example. Just like it shows here, it's a measurement of a firm's ability to generate sales from a particular investment in assets. All right, our profit margin calculation, we've certainly seen this one before. Profit margin, net income divided by net sales. And so net income divided by what we might also call total revenue on the income statement, right? Net income divided by total revenue. And so on this one, we've got a profit margin of 21.96%. And so what that means essentially is that for every $100 of revenue that comes in, we get to keep $21.96 after all expenses are paid, right? For every $1 of revenue, we get to keep, you know, approximately 22 cents after all expenses are paid, right? So that's kind of what the profit margin is showing us. Return on assets. This is net income divided by average total assets. If I'm remembering correctly, I want to say that we did this one together in Principles of Accounting. I can't remember. I want to say it was maybe chapter 2 or chapter 3 in Principles of Accounting. We looked at this one too, but we're taking, again, net income divided by average total assets. To get that average, of course, we're taking beginning of the year assets plus end of the year assets dividing by 2 to get the average. And so we've got a return of 12.37%. Okay, and then, hot dog, let me go back here. So on this one, it says, analyst obtains further insight into the behavior of return on assets by disaggregating it into components of profit margin on sales and asset turnover as follows. So rate of return on assets equals the profit margin on sales multiplied by the asset turnover. And you see, because we have net sales as the denominator in one of those, net sales as the numerator in the other, those two cancel each other out. And we end up with net income divided by average total assets. And so here it shows our numbers plugged in like we've already calculated. All right, here are some of those exercises I hope that we'll be able to get together, at least a good portion of them that we'll be able to do together in class. I always liked these depreciation entries. I always thought it was kind of fun filling out the depreciation schedules and stuff. So hopefully we'll have fun with it. But all right, guys, well, have a good night and I will see you guys later. I look forward to working on these in class together. Bye-bye.